By investing $25 a week into specific market mechanics, you can build a portfolio paying out over $5,000 in monthly dividends. Over the next few minutes, we will look at the specific 5-stock configuration and the automation steps required to scale a micro-budget into a portfolio worth over $800,000. This strategy does not require a high-tier salary or professional trading experience. It relies entirely on a standard brokerage account and the discipline to maintain a $25 weekly contribution. The goal is to move away from speculative trading and instead implement a mathematically sound system that operates consistently over a 30-year horizon. For most retail investors, a $25 weekly budget feels too small to move the needle. On this scale, traditional wealth-building methods often lack the necessary velocity. To solve this, we use a Dividend Reinvestment Plan, or DRIP, as the primary engine for account growth. A DRIP captures cash dividends and recycles them into the market. The system automatically buys a fraction of a new share. This creates a compounding feedback loop. New shares generate their own dividends, buying even more shares, increasing total ownership without depositing an extra cent. While this handles growth, we also need a mechanism to manage market risk. This is where we employ dollar cost averaging. By depositing a fixed $25 every week, you automatically buy more shares when prices are low and fewer when prices are high. Over time, this smooths out your average cost per share, regardless of market fluctuations. Combining a DRIP with consistent weekly deposits helps mitigate the impact of market volatility and reduces the influence of emotional timing on your long-term returns. This automated structure is effective, but it is only as strong as the assets you feed into it. To select those assets, we use a rigorous filtration process. Every potential stock must be measured against 4 specific criteria to ensure they can sustain this 30-year cycle. First, we look for blue-chip stocks. These are established companies with a history of consistent dividend payments and the financial scale to operate through various economic cycles. Second are the Dividend Aristocrats. This group consists of elite companies that have successfully increased their dividend payouts for at least 25 consecutive years. Third, we evaluate high-yield stocks. These provide a larger immediate cash flow, which is necessary to accelerate the reinvestment cycle, though they often require closer monitoring of their payout ratios. Finally, we include growth-oriented dividend stocks. These are companies that offer lower current yields, but have high potential for both share price appreciation and future dividend increases. To maintain a high standard of quality, any asset we add to the portfolio must meet at least 3 of these 4 specific criteria. Using those criteria, we have identified 5 specific assets that, when combined, form the core of this wealth engine. NextEra Energy offers 2.76% yield, 11% growth. Starbucks brings 3% yield, 16% growth. Abbott provides 2.1% yield, and Home Depot gives 2.59% yield, 18% growth. ProShares ETF adds diversification. Combined, the portfolio averages 2.5% yield, 15.49% growth, and 10.87% appreciation. Now that we have the assets, we need to handle the physical execution. This is where the theoretical math becomes a functional account. First, set up a recurring automated transfer within your brokerage app. This ensures that $25 moves into your investment account every week without requiring a manual decision. However, simply depositing the money is not enough. If those funds or your dividends sit as idle cash, the compounding engine will stall. You must navigate to your account settings and flip the dividend reinvestment toggle to the on position. This step automates the recycling of your payouts, reducing the friction of manual reinvesting and ensuring the compounding cycle continues even if you don't log in for months. With the deposit scheduled and the DRIP active, the system is now capable of running for decades. After 10 years, the combination of consistent deposits and early dividend growth is projected to bring the portfolio to approximately $27,000. Look at the 30-year mark. The math shows a total valuation of $823,000, generating over $5,200 in monthly income. The biggest part? The growth. Over $421,000 is from reinvested dividends, not out-of-pocket contributions. This proves that reaching a significant retirement income doesn't require a massive starting salary. It requires a sound reinvestment plan and the time to let the math do the work.